Hi, everybody. This is Dale Branda with Stewart Advisors. Welcome to another session in our ongoing webinar series on topics of interest to our clients and friends of the firm. For those of you who haven't been with us before or who might have missed a session, recordings of all of our past webinars are available in the video library on our website. So you can just go to stewartadvisors.com and select the Resources tab. Today, our topic is Social Security and how you can maximize your benefits and make it work for you. To help me present, I'm joined by my colleague, Tim Obendorf. Tim's a veteran of a lot of conversations on the subject of Social Security and retirement planning in general, so he's well positioned to talk us through the issues. Those of you who are familiar with Stewart Advisors know that we're a financial planning and investment firm, and our mission is to help individuals, families, and business owners realize goals by making good financial decisions. We provide a whole range of services with the goal of helping clients develop a consistent financial plan. And as most of you know, Social Security is a big component of most people's plan. So to many people, the calculations and the mechanisms behind Social Security are complicated, but their strategy is not. You reach a certain age, you claim benefits, and you start receiving a monthly check. A large percentage of Americans just claim Social Security at their earliest opportunity. So as we're going to see in a minute, Social Security strategy is not necessarily one size fits all, and we encourage our clients to use Social Security wisely as a tool in their overall plan. So with that, in that vein, here's what we hope to cover in the next 30 minutes or so. We're going to be talking about the nuts and bolts of how Social Security works and what makes up your benefits. But we also want to discuss some of the strategic issues that you might want to consider to help maximize what Social Security can do for you. And as always, we're going to leave a few minutes at the end to answer your questions. So feel free to submit them at any time using the Q&A button on your console. We already have one or two that came in with the webinar registrations. So if we don't cover those questions in the presentation, we'll be addressing them specifically at the end. So with all that said, let me turn things over to Tim and we'll get started.
Thanks, Dale. A question we get asked fairly frequently is, when should I claim Social Security? And I wish there was one simple answer or rule of thumb that I could tell you, but the answer to that question is really complicated. We've listed here a number of the factors that you have to take into consideration when choosing to claim Social Security. The first is, when will I retire, which is not necessarily synonymous with when you claim Social Security. Second, how much is my benefit? Third, what are the tax implications? Fourth, when should I use other retirement funds? Fifth, which retirement funds should I tap into first? Sixth, when should my spouse claim? And seventh, what's my life expectancy? Over the next few minutes, we're going to address some of these questions and how they impact your Social Security claiming decision. As Dale mentioned, we're a planning-focused financial advisory firm, and we really do believe that the best financial decisions are made in the context of a comprehensive financial plan. And as we noted on the prior slide, there are a lot of factors that impact financial decisions, like when to claim Social Security, and the best way we know to make the decisions, to make them correctly and make them line up with your values and goals, is to prepare a comprehensive financial plan. This doesn't mean that you prepare an 80-page document that gets stuffed in a bottom drawer, never to be seen again. When we talk about a plan, we mean a model of your financial future that can help you weigh the impact of choosing alternate options. The key dates in the graphic will drive many of your decisions. And as you progress through time, you'll want to evaluate how you are tracking compared to your plan and make adjustments. Think of your plan as a living model of your future. Now, to make informed decisions about Social Security, you'll need to understand some of the basics about eligibility and how your benefit is calculated. Anyone who's worked and paid FICA for 40 quarters is eligible to receive a retirement benefit. In addition, spouses, ex-spouses, and widows or widowers of an eligible recipient are also eligible for a benefit. And the amount of your benefit is based on your earnings history. As you probably know, your earnings that are subject to Social Security tax are capped each year. So for 2019, the cap is 132,900, and that's up from 128,400 in 2018. Each year of earnings is adjusted for inflation, and then your highest 35 years of earnings are averaged together. This average earnings amount is what drives your benefit. And you should note that there are earnings levels where the next dollar of earnings is worth less of a benefit. So for instance, somewhere around the first $900 of monthly earnings gets about a 90% application toward your benefit. And then the next 4,500 to 5,000 only gets about a 32% contribution towards your benefit. So this calculation is a little complicated to go over here, but the end result is your primary insurance amount or the benefit that you'd receive at your full retirement age. If you claim your benefits before your full retirement age, the benefit will be reduced. And if you delay, your benefit will be increased. On the right-hand side here, you can see a sample Social Security benefit statement, which shows the monthly amount this person could receive at various ages. So at age 67, and that's this person's full retirement age, their benefit is $1,915 a month. If they wait to age 70, that benefit goes up to $2,405 a month. If they claim as early as 62, then the benefit goes down to only $1,344 a month. Anyone who's eligible to receive benefits can claim their retirement benefits starting as early as age 62 or delaying to as late as age 70. The most frequent choices we see for claiming are age 62, the full retirement age, or age 70. And historically, the full retirement age was initially set at age 65, but over time it's been increased to age 67 for anyone born in 1960 or later. As I mentioned before, there's a reduction in benefit for claiming early and an increase in benefit for claiming later than your full retirement age. This increase stops at age 70, so you could wait to claim past age 70, but there's no benefit. It doesn't increase your benefit, and you just lose out on the months before you claimed. In the table, you can see the multiplier for various claiming ages. So this person's full retirement age is 67, so that at 67, the benefit is 100%. If they claim before age 67, the benefit's reduced by 6 2/3% each year, with the smallest benefit at age 62 being 70% of the full retirement benefit. On the other hand, for each year the recipient delays past full retirement age, the benefit goes up 8% to a maximum at age 70 of 124% of the full retirement benefit. So to put it in dollar terms, at age 67, let's say they were to get a $1,000 monthly benefit. If they claimed at age 62, that would get reduced down to $700 a month. But if they delayed to age 70, that monthly benefit would go up to $1,240. This graph is an analysis we did for a client, and he wanted to know how long it would take if he waited until age 70 to start Social Security to catch up to the amount of benefit he would receive if he started his benefit at age 62. So what we did is we graphed the cumulative amount of benefits he'd receive under each claiming age, adjusted for inflation. And based on his Social Security statement, his benefit at age 62 was $2,085 per month. At that rate, the client would receive about $500,000 in benefits by age 80 and $1 million in benefits by age 92. On the other hand, if he delayed to age 70, he has no benefit until age 70. So you see the green line there where there's no benefit in the early years. And then he'd accumulate $500,000 in benefit by age 80 and about $1.5 million in cumulative benefits by age 92. So the blue line is the cumulative benefit at age, starting claiming at age 62. The red is claiming at the full retirement age of age 67, and the yellow is claiming at age 70. And where you see them all cross is somewhere around age 79 or 80. And it's fairly typical that the break even between those different claiming dates is somewhere around that age 79 or 80. And you may be thinking that makes sense since average life expectancy is around age 79. But be careful about making your decision based on the average life expectancy. As the tables on the right show, you're likely to live beyond the break-even date, and there's a high likelihood that either you or your spouse will live past age 90. The top table shows the life expectancy of a typical 65-year-old. What's interesting is that for a married couple at age 65, on average, one spouse will live to age 89. The second table shows the likelihood of a 65-year-old living to age 90. Men have a 20% chance, women have a 32% chance, but the odds that at least one spouse will live to age 90 is 45%. So the bottom line here is that you need to plan for well beyond average life expectancy. And because the likelihood of one spouse living to age 90 is so high, it's really important to understand the spousal benefits that are available from Social Security. When you apply for your benefit, the Social Security Administration will calculate whether your primary benefit or 50% of your spouse's primary benefit is greater and automatically give you the higher benefit. Note that the spousal benefit is based on your spouse's full retirement age benefit and does not become available until your spouse claims their benefit. There's two situations that we typically see with spouses, and the first is where both spouses have fairly similar benefits and earning history. So for example, let's say the husband and wife each have a $1,000 monthly Social Security benefit, and for each spouse, their primary benefit of $1,000 is greater than their spousal benefit of $500. So each spouse, when they claim, will receive their $1,000 primary benefit. The second situation is where one spouse has a much greater earning history than the other. So let's say one spouse has a benefit of $2,000 a month and the other spouse's benefit is $500 a month. The higher earning spouse will receive their benefit of $2,000. However, the lower earning spouse will receive a $1,000 spousal benefit, since that's greater than the $500 primary benefit they'd receive on their own earnings history. And I'm greatly simplifying these cases, as each spouse could elect to receive their benefits at a different time, and that has other repercussions. So because the total benefits received are impacted from both the timing of claiming your benefit and the timing of your spouse claiming their benefit, it's really important that you work with an advisor to understand the projected benefits of various spousal claiming strategies. Also note that there's a survivor's benefit available to widows and widowers, and that benefit's based on when the deceased spouse began their benefit. So this is just one more variable that you need to consider when you make your claiming decision. We're going to switch gears to talk about how your earnings can impact your Social Security benefit. So there's two ways this can happen. First is if you claim your benefit before your full retirement age, then your actual benefit may be reduced based on other earned income. And the second situation is if your taxable income is above certain thresholds, then your benefit may be subject to taxation. So let's take a look at what happens to someone that claims their benefit before their full retirement age and continues receiving some other outside earned income. And in that case, for every $2 earned above $17,640, the Social Security benefit will be reduced by $1. Fortunately, this reduction is not lost because it gets added back to your earnings record and increases future Social Security benefits. During this period, you'll have to report your earnings to the Social Security Administration. You report it each year, and they'll hold back on the benefit until the earnings reduction amount is met. And note that there's no benefit reduction from earnings after your full retirement age, and your earnings have no impact on your spouse's benefit. Let's take a look at some examples here on the table on the right. There's really three different Social Security benefit amounts that we're looking at here. So one person that could get a $700 benefit, one that gets a $900 a month benefit, one that gets an $1,100 a month benefit. In each case, as long as outside earnings are less than $17,640, they get their full benefit. So for the first person, it's the $700 times 12 months, So over the course of the year, they'd get $8,400. Same thing for the person with a $900 benefit. They'd get the 900 times 12 months is 10,800. But what happens when outside earnings exceed 17,640? So if it's, let's say $18,000, that's $360 more than the 17,640. So half of that excess would be clawed back or reduced from your Social Security benefit. So half of 360 is $180. So this first person, instead of getting $8,400, only gets $8,220. And you can see that's the same reduction for the person that had a $900 benefit, same reduction for the person that had the $1,100 benefit. And let's look at one more example where their earnings go up to $20,000. Now, that increase from 18 to 20, it's a $2,000 increase. So the Social Security benefits get reduced by $1,000. It's $1 for every $2 of earnings. And that's the same reduction for the $700 beneficiary, the $900 beneficiary, and the $1,100 beneficiary. A second impact that outside earnings may have is that you could end up owing taxes on your benefit if your income is above certain thresholds. For a married couple, if your combined income is between $32,000 and $44,000, you may have to pay tax on 50% of your Social Security benefit. And for income between or above $44,000, up to 85% of your benefit may be taxable. The measure for these income thresholds is based on your adjusted gross income plus non-taxable interest plus half of your Social Security benefit. And for couples married filing jointly, that's on a combined basis. So it's your income, your spouse's income, all combined together. These thresholds are not indexed for inflation. So over time, more and more Social Security income will be subject to taxation. Now, one interesting thing with the tax reform and the changes in standard deduction starting in 2018, that higher standard deduction will actually reduce the amount of the Social Security benefit that gets taxed for a lot of people. Also note that some states tax Social Security income. Fortunately, Illinois is one of the 37 states that does not tax your benefit. So that's one of the few breaks we get here in Illinois. I'd like to tell you a story about a client that we began working with about the time she turned 70 years old. And this was a single woman. She was looking for ways to increase her regular monthly income. And she was really concerned about market volatility and wanted to purchase a fixed annuity that would give her an additional $500 a month of income on top of her Social Security benefit. And she had claimed her Social Security at age 66. So to get that amount of monthly income from an annuity, she'd need to spend about $85,000 in premium on an immediate annuity. And what's unfortunate is that if she had delayed taking Social Security, she could have increased her monthly income by $500, and it would have cost her less money. So let's take a look at the numbers and how we can look at that type of a comparison of Social Security versus an annuity. And here we have some numbers where we're looking at someone that could get a $1,600 monthly benefit at age 66, so that's the full retirement age. And alternatively, they could wait until age 70 to get a $2,112 monthly benefit. So to see if waiting is a good deal, we could compare the cost of waiting to the cost of an annuity that pays $512 a month. Since the decision to wait until age 70 means the person won't get a $1,600 monthly benefit for 4 years, the total cost of waiting is $1,600 times 48 months, or $76,800. On the other hand, purchasing an immediate annuity starting at age 70 that pays $512 a month would cost about $85,000. Generally, we've found that waiting to claim Social Security is a little less costly than buying an annuity to get the same income. And one of the other things that really makes the Social Security benefit look even better than an annuity is that most annuities don't index for inflation. And finally, the Social Security benefit is backed by the credit of the US government, whereas annuities are dependent on the creditworthiness of the insurance company that issues the annuity. So as you can probably tell, we're generally fans of waiting to claim your Social Security benefit. But we realize that creates some challenges, such as how are you going to fund those years before age 70? It also creates some opportunities, though, because you may have some years with low marginal tax rates. And this is exactly why we recommend integrating your Social Security claiming decision into a comprehensive financial plan. By doing that, you can identify sources of funding and determine which sources to tap when, such as taxable versus tax-deferred accounts. You'll also be able to identify years where your tax rate may be low and take advantage of strategies such as a Roth conversion. You'll also want to run scenarios with different spousal claiming dates, such as one spouse claiming at age 62 and another waiting until age 70. It's not always clear which strategy will be most successful until you actually run the numbers. The table on the right-hand side here has an example of a cash flow projection from a financial plan. And in this plan, the husband and wife are the same age, and they both plan to retire at age 65, but they want to wait to claim Social Security until age 70. So as we look at this, there's a couple things that jump out. The first is that there's several years in retirement where cash flow is negative. So just to walk you through the columns here, the first column is their income, which includes their salary and earnings before they retire. And then later on, it includes IRA distributions and Social Security income. And then the next column has their expenses. So that's their living expenses, their mortgage, their taxes that they're paying. And what you can see is that at age 65, in the third column, they have negative cash flow. So they need to come up with a way to fund $155,000 of expenses that aren't covered by their income. And then they also have a negative cash flow in the year they turn 67, the year they turn 68, the year they turn 69. So we know that there's some years there that we have to come up with sources of cash to cover expenses. The second thing that jumps out is in those same years, if you go to the far right column, the tax rate is actually very low compared to their tax rate in other years. So their tax rate ranges from a low of 6.4% when they're 69 to 15% when they're 65. As a planner, that tells me that there's probably some strategies that this couple could take advantage of. There's some things like Roth conversions that they could do in the years when their income tax rates are low that'll help their long-term success of their financial plan. And by doing this, preparing the financial plan, doing the cash flow analysis, we can compare the impact of tapping different types of accounts, tapping their tax-deferred versus taxable accounts before age 70, or, as I mentioned, doing Roth conversions when tax rates are low. Here I want to highlight some miscellaneous considerations that often get forgotten in the Social Security discussion. The first is not to forget to apply for Medicare at age 65. If you've already claimed Social Security before age 65, this is automatic. But if you delay your benefit beyond that, beyond your 65th birthday, you'll have to proactively apply for Medicare. And just be aware that you have a 7-month window to apply. You can apply 3 months before your 65th birthday, the month of your 65th birthday, and 3 months after your 65th birthday. Second is that cost of living adjustments to your benefit mean that your Social Security benefit will grow over time. And since future inflation is unknown, this indexing helps manage a huge risk for retirees. Third, your personal health and family history should be considered in your claiming decision. So if you have an illness that may shorten your life expectancy, by all means, you'll want to start your benefit as early as you can. On the other hand, if you're healthy and maybe have multiple family members that have lived to age 100 or beyond, you want to make sure that you take care of the financial risk of living that long. Fourth, you need to think about your survivor benefits and how your claiming decision impacts them. It's not just your life expectancy, but it's also the lives of your loved ones that matter in this benefit decision. Finally, if you go through all this analysis, realize you made a bad claiming decision, there are some fixes. There are things you can do to change your election. First is you can repay and undo the claiming within 12 months. Or worst case, you can suspend your benefit and accrue additional benefits up until age 70. One question you may be thinking is whether there will be any money in the Social Security Trust Fund to pay your benefit. And there's a lot of misinformation swirling about, so we checked the latest trust fund report to get the facts from the source. The latest report estimates that if no changes are made to the program, the trust fund will be depleted in 2034. But this doesn't mean that benefits will suddenly stop. At that point, there's estimated to be enough payroll tax coming in each month to continue to pay 77% of projected retirement benefits. And that's the worst case, but we expect that political pressure will mount to address this issue. And the fix could come in a couple of forms. The first is that they could change the date that people start their benefit. Alternatively, they could increase payroll taxes relative to the benefit. But even if they don't change the program, Congress could and is really likely to authorize that there's payment of benefits out of other government funds beyond the Social Security Trust Fund. So when you put that all together, our view is that a reduction in Social Security benefits is really unlikely, and that this is still one of the best sources of secure income in retirement. Finally, if you haven't done so already, check out your benefit and earnings history at the Social Security website. You'll be able to see your estimated benefit based on your earnings history, and double check the earnings history because you want to make sure that your benefit calculation is correct. Also, by setting up your online account, it's really one of the best ways to deter identity theft. So this last page here, we've just listed some resources to help you in your decision-making process. Obviously, Social Security, the Social Security Administration has a very helpful website with a lot of really good information. A second website we'd recommend is livingto100.com. There you can put in some basic information about your health history, and you get an estimate of what your life expectancy is. And of course, the IRS is really the source to go to find out how the government taxes various retirement plans. So irs.gov is a very helpful site. The AARP also has lots of really good information about all topics concerning retirement, but especially around Social Security. And then the Financial Planning Association has some publicly available white papers. You can find those at plannersearch.org. There's a variety of topics, but included in those topics are issues related to Social Security claiming. And then we've also put together a helpful one-page set of questions to help you think through some of the key areas that need to be addressed in your retirement planning. Including Social Security, but it covers a lot of other topics as well. So you can go to our website and download that very helpful white paper we've put together there. So with that, I'm going to turn it back to Dale for Q&A.
Thanks, Tim. So as promised, we have a few minutes left to answer questions. Again, if you want to submit a question, just use the Q&A button on your toolbar. Also, if you've got questions about Social Security or any other financial matter and you'd like to discuss them with us offline, feel free to contact Tim or Mike or me at any time. We're always happy to provide a complimentary consultation. So with that, we actually had one question that kind of came in with the registrations, and this concerns a government pension and how that interacts or reduces Social Security.
Sure, that's a good question. There's really two ways that government pensions can impact Social Security. The first is for somebody that has both worked at a government agency that was covered by a government pension and didn't pay into Social Security during that employment, but then either before or after that, they worked in the private sector or a government agency that was covered by Social Security and put in enough quarters to receive a benefit from Social Security. And Congress put together a provision, it's called the windfall elimination provision. It was basically to make sure that people aren't double dipping from government pensions and Social Security. And the way it works is that if you're eligible for both, you could have a reduction in your Social Security benefit. And the maximum is roughly a little bit over $400 of reduction in your benefit. And it depends on how many years you worked and contributed to Social Security. But just be aware that there's a kind of coordination of benefits between your work at a government pension covered employer and a Social Security covered employer. The other way that government pensions could be impacted is if you are eligible for a Social Security benefit, or actually if you're eligible for a government pension, but then are also eligible for a spousal benefit, the amount of your government pension could reduce your spousal benefit by up to 2/3 of the amount of the pension. So just a couple ways that the government is making sure that people are not double dipping from pensions that were designed for people not on Social Security and also from Social Security itself. Dale, any other questions?
Yeah, we had one about survivor benefits, and this harkens back to a couple of slides we had earlier in the presentation. But the question is really just, can you flesh that out a bit? Say a little more about survivor benefits, how much, how do they work, et cetera.
Yeah, so any worker who's eligible for a benefit and becomes deceased, their benefit becomes available to their widower and potentially to their children if their children are under age 18, or to your widow who's caring for a child under age 16. And if you are a widow or widower, at full retirement age, you actually are eligible for 100% of the deceased worker's benefit amount. And you could claim that at full retirement age, it's 100%, but you could claim it as early as age 60, and it would be discounted depending on the date you claim, the age you claim, could be discounted where you'd only get 71.5% to 99% of the deceased worker's basic amount. The other thing to note is that that benefit is based on whether or not the deceased worker had started claiming their benefits. So if they hadn't, or they claimed after their full retirement age, it'll be based on their full retirement age benefit. If they claimed before their full retirement age and then passed away, that reduced benefit amount that the deceased worker was getting would be the basis for the survivor benefit. So it's several places where a widow, widower, dependent children can benefit from a deceased worker's Social Security benefit.
Okay, we have one other question, and this is how do spousal benefits work in a situation where someone's divorced?
Yeah, so that's a really good question, because if you've been married for more than 10 years and then are divorced, you are eligible to receive a spousal benefit based on your ex-spouse's retirement benefits. And it works just in the same way that a regular spousal benefit does, in that when you file to claim your benefit, the Social Security Administration is going to look at either the greater of your primary benefit from your work history, or they're going to look at 50% of your spouse's benefit and look at which one is greater and give you the greater retirement benefit based on that. Now, if you are divorced and remarried, you're no longer eligible for the spousal benefit from your prior spouse. But again, it's if you've been married 10 years, you're still eligible. And it doesn't really matter when your spouse claims their benefit. When you claim your benefit, you get it based on their full retirement age. So just one other factor to keep out there. When you do eventually make your Social Security claim, the Social Security Administration will look up and compare that divorced spouse benefit to your benefit and make sure you get the proper amount.
Okay. I think that's all the questions that we have at this point. And so with that, I will thank everybody on the line with us for joining us tonight, and we look forward to seeing you at future webinars. Thanks so much.